And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of what will happen to employer health tech? The employer health tech sector is rapidly evolving, buyers are raising standards, and players are consolidating. Our guest today is Marcus Osborne. Marcus is the previous executive chairman of Rightmove Health, a virtual movement health company, and the former SVP of Walmert Health, and you can follow him on LinkedIn. This show is being recorded and will be included in my podcast series called the Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify. We always love getting 5-star reviews. We have a new podcast links for our show, so make sure you see recent episodes on Apple and Spotify when you subscribe, or you might be on the show's old page. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It lasts about 90 minutes, and Marcus and I will spend the first part discussing the news and the macro picture and some other topics, and then after that, we'll focus on our special topic of the day. And we'll be taking your questions throughout the show in the LinkedIn text chat. So, Marcus, welcome to the show, and please introduce yourself to our audience.
Well, it's a pleasure to be here. So maybe a quick intro. I was joking earlier. As I think about myself, I'm the father of two sons, one who's about to graduate from high school. So the main thing to know about me is I'm very close to being an empty nester, which is very surreal. So that's one. But two, have spent most of the last kind of 20, 25 years working in healthcare and coming at it from some odd spaces. I spent 15 years at Walmart running health services businesses and engaging with payers, but doing it through the lens of a retailer, more recently engaging with a startup in the digital health space. But even I think back to my Clinton Foundation days when I was working on how do you improve access to HIV and AIDS treatment globally. So I'm definitely not your kind of traditional healthcare guy by any means. And so I think that's which I enjoy. So I come at this business and this sector a little differently, I think, than most.
Well, thank you. And I think our audience, is very favorably impressed by sort of what Walmart has done in healthcare, and was also probably cheering for Walmart in primary care. And then more recently, we've seen that strategy change. And so, can you tell us sort of what was the change? I know Walmart, I think they're exiting primary care in the store, but what is the change, and what do you think is going on?
Well, the change actually more specifically was exited or sold one business, a virtual primary care business, but the other one was the Walmart Health business, which was not just primary care, but it was actually a kind of multi-service center that had primary care, mental health services. In some locations had physical therapy, and all the locations had dental and vision and hearing and other services. I think it was driven by a number of factors. One, it's a tough business to run. It was a tough business to kind of manage. The pathway to profitability on it is it takes a while, and you have to be committed to it. And there's a lot of other things I think the company is involved with. And so when you think about capital and resources and being, even in Walmart's case, as much capital as they have access to, they don't have unlimited capital. And so I think you have to make decisions. What I do think, and I've said this not just about Walmart, but you look at some of the other retailers that have slowed down or exited certain, particularly health services businesses, what I would caution anybody to say is don't read it as the retailers are getting out of the healthcare business. I think what instead is there's an enormous amount of learning that came from those experiences, the ones that work, but particularly the ones that didn't work. And I think from those experiences, it's thinking, that all of those organizations, and not just the Walmarts, but the Walgreens and CVS certainly, and they're a much bigger healthcare company. But I think Kroger and Albertsons, now that merger is not happening or is unlikely to happen, each of them, what are they thinking? Amazon, and what are they thinking and doing? That retailers particularly have learned a lot and have gotten a lot smarter, and it's informing the path that they're going to take. So, I expect, I don't know that I'm not going to predict that Walmart's going to do anything in the next 12 months. Maybe they will, maybe they won't when it comes to healthcare. But I would caution anybody and say, as you look at the next 5 or 7 years, I would expect things to happen, and I think the things that happen will reflect the learning that came from the Walmart business, the Walmart Health business, that came from even going back 20 years ago to the launch of the $4 generic program at Walmart. All those programs, all those businesses, all those initiatives generated enormous learning to influence the direction that a company like Walmart as a retailer will take in healthcare.
Yeah, thank you. And just to remind our audience, we in the industry have been watching Walgreens expand Village MD and then suddenly, pull back, and CVS expand convenience care clinics and minute clinics and pull back, and also Walmart in primary care and the other areas that you mentioned as well. And so 5-10 years ago, we thought this was the future, and we thought it was good for patients, tough for doctors because doctors have this competition. You want to start your own primary care medical practice as a doctor with a license. You're competing with CVS and with Walmart. But now it seems it's not so clear. 5 years ago, it seemed clear this was the future. And now it seems not so clear what's going to happen. Is the little doc back in charge now, or is he never going to get back in charge? So we'll see. But interesting juncture. Just in the last, I'd call it 2 years, we've seen these the sort of the big chains have pulled back from primary care.
Yeah, the one thing I maybe will add there is I think you're right. I would also say that one of the things I think it is a reflection of is the challenge, the movement that we're trying to make systemically into value-based care, and that has largely been focused on primary care as the driver of models for value-based approaches. What I will tell you is, if anything, I think it's sort of easy to interpret that as a retail issue. What I would actually say broadly is value-based care is the future. We're moving to more of a value orientation, away from fee-for-service to fee-for-value, certainly from a payments perspective. But as we think about the models, the care models specifically that functionally enable approaches to creating value and enabling value, what I will tell you is, if any, some of what you just described is less about retail and is more about value-based. We're in the early innings of finding the right approaches to value-based models that work. And when I say work, meaning that they drive real impact, that they can financially sustainable, and that they are scalable and repeatable. And what I tell you is, we haven't actually found those models yet. We have found some, that they show some of that promise, but not sort of fully capable yet. So, but that's a good thing. So we're learning. I think the whole system's learning, which is we don't have value-based models yet that truly work. We have some that are better than others, but we're still in the early innings. And so I think some of what you saw from, and I used the example of Walgreens, is it's the reality that we're in the early innings of value-based care and are understanding what it really means to create models that function well. And so the good news is there's a lot of innovation going on in that space. I see more coming, and so that gives me hope.
Well, thank you. That was a great overview of what the Walmart and also the Walgreens and CVS moves mean. So thanks. Good. So moving on to the next category, and for our audience, feel free to jump in with your questions. So macro news. The NASDAQ has been doing well this year. It's at a near all-time high of about 19.5 thousand. I think a lot of us feel dumb and guilty because 2 years ago, if all we had done was just put our money in the NASDAQ, it would be up 95%.
Mm-hmm.
And I don't think people saw that. And it's been driven by the Magnificent Eight, basically. First, they did very well in COVID and post-COVID. And second, they're doing very well with an egg boom right now. So high NASDAQ is very good for digital health, given where it is right now, because it means that private companies can look at high NASDAQ valuations and say, we ought to be able to go public and get valued at about that level as well. So if you're in the innovation economy, high stock market prices are good because they drive continued investor interest in young companies. And then I would say that currently in the innovation economy, there's a mood of disappointment, actually, which is that starting 2-3 years ago, the Fed raised rates faster than ever before, and the innovation economy responded to that with panic. And then the Fed began calling flat rates in the future. They stopped raising rates, and that led to a return of calm. At least we could expect what was going to happen next, with the Fed clearly telegraphing us that it was going to keep rates flat. And then the Fed kind of telegraphed an aggressive cutting period. And now the Fed's walked that back a little bit. That's where the disappointment comes in, which is we would have liked to have seen rates, the risk-free rate, the federal funds rate, go from 5.5 down to 3 rapidly, or lower than that. And instead, it seems like it's going to come down a small amount and then go flat again because of continued inflation, fears. And so inflation's bad. I don't want to sort of throw shade on the problem of inflation, but in the innovation economy, we really want to see both inflation beat and rates come down, which then makes young, growthy companies like our companies worth more and investors more interested in them. So, any thoughts on that? That's kind of what we're seeing and there's a lot of expectation that we're going to learn more. We're going to learn more about stock market prices. We're going to learn more about interest rates. We're going to learn more about inflation and job growth in the next months, which will set the tone. So, Marcus, any other thoughts on the macro environment or?
No, I think you sort of nailed it. I think. And in many ways, you're the only story that I think is interesting, tying into your NASDAQ growth story, which it was driven by the tech economy and by software businesses and by AI and other things. It was not driven by healthcare, right? It was not, as I look at the health insurers and the health systems, particularly, the last kind of 6-12 months has been a tough run. I mean, some have done okay, but for the most part, it's been tough. And so it doesn't sort of reflect the challenges in the healthcare sector. I would also tell you that sort of there is probably some euphoria behind some of the rise that, focus on tech, because, when I was listening to a great economist give a talk just a couple weeks ago, 3 weeks ago, I think, and their sort of mention is that the investment and belief in technology is where the Fed believes that increased interest rates will help tamper down inflation. The market and investors believe that technology can help drive down inflation. Said differently, you want to, let's use the example of healthcare. The promise of AI is in the ability to, can we reduce the administrative burden and the administrative expense that we bear systemically? Can we, improve the efficiency and effectiveness of the providers that we have delivering care? Can we have things kind of operate better? Well, if you believe AI is capable of making that happen, then one of the benefits of it should mean that costs come down, the cost of the care that we're delivering drops. And so I think there's a little bit of kind of interesting reality that it's not just the Fed who can impact inflation, it's the technology companies and the software companies and the AI companies and all of them continuing to innovate, drive that innovation into sectors like healthcare in the hopes that it will actually have an impact of, at a bare minimum, slowing inflation, if not potentially, lowering prices and lowering costs to operate. And so I think it's interesting. It's interesting. But that has to now happen. It hasn't happened yet, but the hope is it will happen. At least it hasn't happened yet in healthcare that I've seen.
And we'll talk about the Transcarent Accolade deal that was announced this morning soon, but I noticed that a lot of the language around that, as an example for our audience, was around cost cutting for the employer benefit leader.
Yep.
And it's a tech company, not a services company. So that's using technology to deliver on the promise of cost cutting. And certainly in B2B, you can often point quickly to cost cutting. And in healthcare, it's quite hard to real cost cutting on the back end. So, and I thought I would just briefly touch on the topic of the election. Our audience has probably heard a lot about the election in healthcare. Maybe we can try to see what it would mean for the employer health tech sector and the employer benefit leader who buys software. But I'll just mention what I've been hearing repeatedly is that large M&A was held up by the Biden administration, and this had a chilling effect on M&A. But literally, selling your portfolio company is how VCs make a return and get money to harvest to put back into new for their LPs, so the LPs can put it back into new funds. And this was causing a congestion or constipation problem. And people think that we'll now see a step up in M&A activity. And then also, RFK is a real wild card in that pharma is thinking that RFK could stop DTC ads, which would be a big deal for pharma, or he could somehow cut high drug prices, which is a two-edged sword because nobody likes high drug prices on the face of it, but high drug prices, America pays for innovation in pharma, and almost no other country left on earth does pay high prices for drugs for innovation in pharma. And so this is a case of killing the goose that lays the golden eggs, maybe in pharma. So those are just some shocks people are wondering about today. But what do you think are the big impacts of Trump and RFK, and anything that you think would directly affect employer health tech?
Well, and I'd also add, Dr. Oz's role at CMS and some of I certainly there are people who I know that are way more educated on this. The couple areas that kind of do stand out to me. I mean, you hit one of them is there more openness to, as you think about M&A, to allow some of these mergers and unions to occur? I know it's a topic that I do think there is a reality that as large as the U.S. healthcare sector is, there's a lot. It's amazing to me how often it feels subscale. Subscale in the sense that it's often hard to find solutions that are national in nature. It's you look at, there are so many point solutions out there, and so then you have this point solution fatigue. It certainly applies to the digital health and employee health tech space. But and so what you really pine for is somebody who plays an integrator role that can bring together a wide array of solutions that are integrated, that just make it easy for you to go one-stop shop. And so I think there is, there's been a lot of conversation about how do we support and allow groups, encourage more scaled solutions and more integrated solutions in the market, while at the same time not discouraging competition. And so I think there's sort of a healthy balance. My sense is, if I were a betting person, that I think the Trump administration would appear to kind of favor, enabling organizations to try to achieve more scale, try to, supporting some of these integration efforts. So I do think you'll see more of that. The other piece that I'd highlight is, and this goes to RFK and Dr. Oz and some of the leadership at the Health and Human Services, it is interesting their focus. I'm going to use the term on wellness, more broadly. You did talk about a focus on pharma, which I do think there will be, but about wellness, and you think about, there's been a lot of discussion. Is there potentially more regulation coming to food manufacturers to try to force them to, particularly those who are packaged food, to change what they're making to make it more healthier, or at least less unhealthy? But what I actually think that means is I think it's gonna increase the amount of innovation we're seeing on the sort of wellness side of the house. I think that means that some of the things you're going to see from those leaders at HSF are going to kind of open up doors in the same way that I think under the Biden administration, you saw a lot of focus on social determinants of health, and you saw a lot of companies then form to go after the SDOH space. There have certainly been a lot of wellness companies, but I think we could see more pop up and more innovation occurring as they define government policy to be more focused in that area. So anyway, so I think it's going to be, I think that's a good thing. And so that's what I'm kind of watching, is what are those, where they're focusing, who are the interesting startups that are going to kind of come into that space.
One joke I've heard is that the fad RFK diet is sweeping the country, which is that you print out an angry photo of RFK and you stick it on your pantry. Then also I've heard, half serious, half tongue-in-cheek, that as a national security initiative, the U.S. government should buy the rights to Ozempic and then make it available free to the public. So I don't know if you
Well,
what you.
I think the unfortunate reality, if I'm not mistaken, that Novo Nordisk's market cap is now equal to their home country's GDP. So it begs the question: would it be cheaper to try to, in Trump's country acquisition strategy, is it cheaper to try to acquire the country or the company? So, yeah.
Well, good. So, and for our audience, if you have any questions about macro trends and the election, feel free to throw them in the comments. And so, moving on, I think we'll see. I haven't seen yet. There's quarterly fundraising reports on digital health, and I haven't seen those yet for the fourth quarter. We should get those any day now. But have any reports come out in the last couple of weeks that you've seen with interesting findings that you want to share with our audience?
I don't know that any of them I've seen with any interesting findings. I think it's less about reports and more about some, conversations and that particularly right, between Thanksgiving and New Year's, where it has been a very sort of tight fundraising environment. I would say, again, this is not backed by any data reports from any agencies or any groups that sort of track it, but it's from some of the being able to engage with a number of venture funds and some of them in the same room together, them talking that they were engaging in more deals and deploying more capital and had deployed more capital in the last 60 days than they had in the previous year. And so it leads me to believe that, some of it maybe was tied to the election, and not just who got elected, but just the election generates so much angst and anxiety and chaos and noise that it was just hard to do anything else. I think there was an interesting study that's going to be published here from an economist about how the election, just all the coverage and everything else, actually diminished American productivity because we were so captivated by it. And so we were so captivated by what was going on in the election that we didn't do our jobs or didn't do them as well. So I think a little bit of that applies to the venture world, where it feels like, if I'm reading the kind of tea leaves just based on the commentary, not based on any reports or data, it does feel like a lot of these groups in healthcare are starting to kind of deploy capital, and that they've had capital for a while, but it's now going out the door. What that tells me is it's probably driven by three things. It is being driven by three things. One is the anxiety's diminished. They feel better about things. The election, is a big driver of that. Two is they probably need to deploy some capital. When you sit on it for too long, you need to get, start getting money out there. And three is that, you're finding good quality companies, and not just good quality companies with valuations that are reasonable. And I think that last point is a big one, which is what I'm hearing from an evaluation perspective. A lot of companies have taken some haircuts and had to, bite the bullet to say, if we still want to be a going concern, we're going to have to address our cap table. And so now some of these investors are able to come in and get into a business that they couldn't justify, or couldn't afford before, and now they can. So I think some of that is coming around. So that, I think that does, as we round into now that we're into 2025, I think it gives some hope. It'll be interesting. Next week will be a big bellwether in San Francisco with everybody getting together for the JP Morgan related events to see kind of what the tone and tenor is. That's probably one of the two big, for me, healthcare bellwether events, and we'll talk more about that later. But it'll be interesting to kind of see people's perception of things coming out of that event, and whether that what I just described is in fact true.
Yeah, thank you. That's actually one of the more optimistic takes, in that in the innovation community of young companies in digital health, they've been very upset that second quarter and third quarter were not great quarters. And then fourth quarter seemed like it was also not going to be a great quarter, but maybe post-election we've seen an uptick, which the community's been waiting for a long time. We could even see the Rock Health, the other people who publish these quarterly reports come out with a report before JP Morgan, which if it shows a spike in the last 60 days, that would get great, they get very positive attention at JP Morgan and set a positive tone. So we'll see.
We'll see.
And I'll be at JP Morgan, and I invite for our audience, reach out to me if you want to try to connect at JP Morgan. I also agree with you that not only did a lot of investors, I think, were anxious before the election, so both investors and young companies that need investment had their productivity sapped and were procrastinating before the election. And partly it was a concern that we might see 30, 60, 90 days of chaos after the election. What happens if someone doesn't accept the results of the election and there's nonstop marches on Washington thank goodness we didn't have that. And then another issue was, I think, more today than 10 or 20 years ago, people running for president don't necessarily unveil detailed plans. I remember back in the 90s, there was the Contract with America, which was like 10 laws that will promise to vote on immediately or whatever. And here they are. And today you had Kamala was not explaining how she'd be different than Biden, and had a very compressed time, didn't have a lot of time to run her campaign. And then Trump brought in RFK, but neither one of them made it clear exactly what they would push for and in what priority. And then when it looked like Trump had won, RFK then backtracked a little bit on vaccines. He laid out an agenda that was not very objectionable. Before,
Yep.
We're going to safety test vaccines to the extent they haven't been safety tested already. And that was different than what he said, than some of his more fiery speeches he'd given in the past. So I just bring up that, I think this particular election not only sapped national productivity, which you're mentioning, which an economist would measure, but it also led to both VCs and young companies who need the money just wanting more certainty.
Mm-hmm.
And therefore waiting. Interesting. So next we'll hop on to some discussion about the IPO environment. So one of the pennies that needs to drop is we need to get the IPO window open again. And historically, the IPO window shuts and then opens. And it's been enough time since it shut that it's time for it to open up again. And we have NASDAQ at record highs. And so there's no reason we shouldn't have an IPO window open. And usually the way this happens is, so currently, the IPO window is closed, and most companies that would like to IPO are hearing bad things from their bankers and so are not seeking to go out and go public. Usually what happens to change this is that a top bank will bring out a large, high-quality company for an IPO, and that will be very well received and be successful. And what successful usually means is that the stock price goes up 15% and stays up. If that happens, then the key party here is the IPO buyer, who's a portfolio manager at the large money managers like the Fidelities and BlackRocks and Citadels, the mutual funds and hedge funds. And if that happens, then they will signal we want more. And then at that point, there's a large supply of young companies at IPO stage who've got bankers in the wings who will try to go out and capitalize on this demand for IPO product. And what I've heard is that those buy-siders, they want IPOs, but what's holding them back is they're hesitant. They are hesitant because in the aftermarket of many recent IPOs, they have not gone up 15% and stayed up. They've gone down or whatever. And so they're looking for, and what I heard recently that, that the following companies are sort of in line to potentially IPO that could be that large, high quality company. And that is Stripe, Medline, Instacart, SpaceX, and Klarna. And so, and of those, I think most people know SpaceX. SpaceX is probably the one spoken of most often, Stripe second most often. And so, these companies could go out, and if the IPO window opens, then there's many digital health unicorns where the revenue is big enough for them to be a sustainable public company, or where the investors have been behind it for so long, they are pushing, they want to get out. The IPO is the obvious way, and they're pushing management to take the earliest opportunity. And so those, I think PitchBook came out with a report recently, and they mentioned ZocDoc, Row, Hinge, Omada, Color, Everly, Noom, Lyra, Devoted, and Somatus as companies they think could IPO. And then There was some story about Omada and Hinge filing something or other, and I tried to look that up. I didn't see what exactly. It wasn't a full S1, but it was some kind of filing that they. If it was a full S1, everyone would be reading it and talking about the details. So that's what we're waiting for, and then. But I haven't seen the announcement of one of these potentially big market-moving IPOs that could open up the IPO window. So, Marcus, any thoughts? Do you think? And then, sadly, digital health companies used to have a major halo over them for private investors and public investors in IPOs, and their performance of a number of them has been so poor that I don't know if you might see that IPO investors want B2B but not digital health. So we'll see. So any thoughts on the IPO environment, Marcus?
Well, I think you sort of just nailed it. It feels still very uncertain. I would say specifically in the healthcare space, there are also a lot of investors that I think have a bad taste in their mouth. I mean, I think I know we kind of referred to Glenn Tolman earlier, but I don't think if you were an IPO investor or an investor, you look very favorably at the, Livongo, Teladoc, and there have been a few that I think Castlight, that sort of came out with great promise and, in some cases billions, tens of billions of dollars of valuation, and ultimately weren't worth that, were worth hundreds of millions. And so one of the things that I've been hearing from some of the bankers is that, the IPO window is going to open, but there's just some doubt about the healthcare innovators that want to IPO. Bright Health is probably a great example as well. High flyer, and then that you look at sort of what it just got revalued at in that transaction. I mean, it got taken private, and it was a small portion of what it had been worth. So I think there's a little bit of a question about who in the healthcare innovator side wants to be the first one, because you're coming into a market that you haven't seen IPOs on, and that too, even if the market kind of opens with some of these tech companies like you mentioned, SpaceX or Instacart or Stripe or others, which may be interesting, do you want to be the first healthcare tech, health tech or digital health company to go into it? Because it's not an industry that has generated a lot of love recently. But I think to a point you made earlier, the one thing that I have heard is the market really needs to have a healthy IPO market, particularly for the healthcare digital health space, because we need to start to clear the deck some. I mean, we need to. Your point is, the same way of selling a portfolio company to a strategic. Yes, that's great, but also being able to IPO a company so that you generate a return, so you can put those returns into other businesses. That sort of the stalling of the IPO market has really had a profound effect on venture investment, and so in healthcare. So I'm hopeful, but I don't know. I'm still very leery because of, not just because the market's been bad or tough for IPOs in general, but because healthcare in particular hasn't been stellar from an IPO perspective.
Yeah, so what you've seen until recently is that, first of all, there's been massive entry since 2009 was the global financial crisis, the Fed's ZIRP policy, and also meaningful use, $40 billion government subsidy dropped on the heads of hospitals for EMR purchases. And so a generation of entrepreneurs moved into digital health at that time. And it was like a great opening up. The opening of the Wild West before the introduction of barbed wire in software and healthcare in 2009. And since then, there have not been a lot of great exits. There's been many venture funds have moved in, many venture partner investors have moved into the sector, many LPs have moved in, capital's moved in, new companies have moved in, products have moved in, talent has moved in across the board, sales talent, software development talent, medical talent have moved from medicine into digital health, etc. All of this massive entry into the sector, but not a lot of great exits from the sector. And a lot of the results of this is today's unicorns, which have not been able to go public And also, if they were highly valued, then they were not attractive acquisition candidates either. So you might have had an Optum or even a Salesforce.com, and they're trading moderately at moderate valuations. And then they look at buying a digital health unicorn at an astronomical valuation at the time, 3 years ago, and they don't buy it as an acquisition candidate. And then it also doesn't go public either. And so these companies are now, over a decade old, and investors from the beginning would like a chance to exit and are pushing to exit. And this actually raises something I wasn't going to necessarily bring up on the show, but there is a concerning, I'll call it the doom thesis. And this is, I think, there's versions of this, and the most prominent is the Matthew Holt doom thesis. Many people know Matthew, but the multi-part doom thesis is that you have companies that were up-and-coming digital health companies. Maybe they attained unicorn status, and they did so during the great boom, and they achieved a high valuation, and maybe it was 15 times forward revenue or 20 times forward revenue or more than that. And that seemed good at the time, big fundraise as well. But now their old private market valuation is still what it used to be in the past, so over $1 billion. But they mark to market against public comps of digital health companies. And so their last private market valuation might be, I'll just make up numbers, 1.5 billion. But they're marked to market against public comps, they're worth $200 million. And then they have a $600 million preference stack, which means that the management is only going to get access to its share of equity if that valuation rises significantly above the $600 million preference stack. And so what's going to have to happen with this company? They're going to have to be valued at a much higher rate than they currently are. And then the board may need to pass some stock option gifts to key employees to keep them with the company, and then it'll be worthwhile. And what can happen in that situation is that you can have another tech boom happens, like the AI boom of young companies in digital health. And so those top product developers, those top executives, those top salespeople leave the incumbent, the unicorn, which faces big cap table problems ahead of it, and go and jump to an AI company instead, where there's a clean cap table and there's a great new growth story ahead of them. But there's a second problem then, is that you have these young AI companies, and you can view digital health as being software teams are trying to address the big expensive problems of healthcare. And they're often the same problems over and over and over again. And so now, not that unicorn, which is not built on generative AI, and which can't just develop a completely new product. It would cost too much for it to develop a completely new product based on generative AI. But now you have multiple generative AI startups that are claiming that they do everything that the unicorns do in the same sectors for the same budgets, solving the same problems. But now they're faster with product development and cheaper code base, and a product that does more, that's more modern, that does more. So now what's happened to the unicorn? Did they miss their chance here? So that's a version of the doom thesis that I've been hearing. That I hope, I'd like to see valuations go up and everybody exit and decide to do it all over again and start their next startup as well. But we'll see. So that's what people that's what people in the innovation community who are sticking to their old job are worried about.
Well, I think it's a legitimate concern, and you sort of talked about it. I mean, we're still trying to comprehend, the COVID phase and the open checkbook reality that existed in the market. And, there were a lot of the companies that, including a couple of them, I'm not going to I don't want to nail them here for any reason, but that were on your list of potential IPOs that absolutely benefited immensely from the spending that came out of the COVID years. And then when that spending has ended, it's called into question, their revenue, where do the revenues come from? Where does the growth come from? And then you hit it. At the same time, now the market's expecting anybody that's in digital health or health tech to be, wildly oriented to AI and AI investment. And it's hard to kind of make that pivot. And so, I was probably positive up until this point, and this is the thing that has me the most concern is that kind of reality. And it just may be that there are gonna be some businesses that were unicorns that are still valued at a lot that, fortunately and unfortunately, they're gonna have to be flushed. And I don't know who those are, but and sorry for those investors and sorry for those founders and for those employees. But I do think there's some market cleanup in healthcare specifically that's going to be that it's happening, but it's going to have to happen more. It's going to have to happen more.
And the joke I'm hearing is that if you're raising money, if you're raising seed, you're raising Series A right now, it's a lot like going into an airplane in the first class section or the coach section. So if you're a generative AI startup, then you get the hot steamy cloth in your face, and they hand you a real glass flute of champagne. But if you're not a generative AI startup, then you go sit in the back and coach, with a very cramped seat is kind of the way I'm hearing it described in the fundraising market. So now moving on to business and trade journal news. And for our audience, if you guys know of any business trade journal stories you want us to comment on, feel free to throw that into the chat. Not a lot of fundraisers the last week or two, and that's probably, a big deal of that is that people are on vacation, for example, and there also might be some meetings pushed off to do them in person at JP Morgan, for example. But I think the biggest news of the last week or longer is that Glenn Tolman, the Livongo guy who now runs Transcarent, which is on the prowl to make acquisitions, has announced a big acquisition, which was buying Accolade, a publicly traded company in the healthcare navigation space that sells to the employer benefit leader, for $621 million. And this was financed by General Catalyst. And Transcarent will take Accolade private. And Transcarent had revenue of $414 million. Well, that's interesting. That suggests a multiple here, 1.5 roughly, or less than 1.5. They also had a net loss of $100 million. And so just a couple things to draw from this. First of all, that is a very low valuation multiple. And I'd love to see the top line growth number. I didn't have that handy. And they're buying it for a stock price of about $7. And you go look at their stock price chart, and their past high was over $55. And so this is one of those companies that IPO'd with a great story and suffered major multiple compression, valuation compression, related to probably a bit of stumbling in their growth and margin story, but also overall multiples coming down for the whole sector in the market correction that we've had. But that's quite a, so Transcarent and Accolade was widely viewed as an innovative, good company with great customers. And so Glenn Tolman is able to buy this company for a song. So he managed to sell Livongo at an extremely high multiple valuation. And now he's managed to buy Accolade at a very low multiple. But also we see that Accolade has been around a long time. It's been around a long time, and it has a net loss of $100 million. And this is a complaint that I'm hearing, which is that these mature unicorns or public companies in digital health still aren't profitable after, and we don't know if that's spending on growth or if that's that fundamentally it's hard to get to profitability with these companies. But that's not good. You ideally want, in a 10-year arc, your software company to be massively profitable unless it's spending on growth. And so this could explain some of the disappointment in the sector and also the low valuation multiple, less than 2x of revenue. And so now they also made a statement, this is Fierce Healthcare commented that the transaction is expected to bring Transcarent's generative AI-powered wayfinding and care solutions. So Transcarent is being on the cutting edge and being buzzword compliant here. And it's cancer care, it's surgery care, it's weight health, along with its pharmacy benefit offering, together with Accolade's personalized healthcare platform and experience in advocacy, expert medical opinions, and primary care. So that's a comment. I like that comment by Fierce Healthcare, what it's combining together here. And this is playing into a macro trend, which is that sophisticated buyers at large enterprises of health benefits are much more mature these days, and they would like to buy a suite of services. And so Transcarent, by making this major acquisition of many more services, is now able to offer a greater suite to the buyer. And so this is the biggest acquisition news in a while, and a lot of people have their eye on Transcarent. They view Glenn Tolman as smart money, executing on a good strategy, which is a secret strategy, and so therefore what is revealed by what he does. And so people are very interested in this deal. So Marcus, any thoughts on, and I'll just add that I have a thesis out there that we will see a major consolidation in employer health tech, and this is an example of that kind of consolidation. So was the merger of Virgin Pulse and Health Comp that happened a little while ago. These are examples of mergers in this sector. And that the two critical subsectors for the employer health tech market are care management, that would be like diabetes and hypertension and musculoskeletal, and then navigation. And the reason is that care management is the biggest sector that matters the most to employers, and navigation entails this promise that employers can be clever and can bend medical trend down over time by using navigation with their employees. They can bend medical trend down by educating and helping the employees choose less expensive care, make better decisions using navigation. So those are the two. And here we see Glenn Tolman getting into navigation, one of the two critical sectors. Marcus, any thoughts on this particular deal?
Yeah, no, I think you're right. I mean, I think there's two things, again, just to kind of reinforce that I think are. One is that the value, I think this idea of integrated solutions are that this has been a point of contention for a lot of employer benefit buyers for a while now, that again, they're overwhelmed by the amount of point solutions in the market. They don't have the sort of capacity to manage 10, 20, 50, 100 different vendors and suppliers of solutions to help address the full range of needs they have. And so it's, that is why they, either continue to kind of work through their ASO or expect their kind of TPAs to bring them solutions, or, it's the advantages that groups like Optum and Evernorth bring. So that meaning that I just want to work with one group who can bring me the kind of complete solution I need that makes my life easier. But the other thing that I think that's important to note is it's not just working with groups that have the full array. It's real that there's also increasingly a sense that there's real value, and I think this is where you're going, to integration, to real integration. And what I mean by that is, imagine this from, a consumer, patient, employee perspective, that you have an individual who, I don't know, something in there, they've gone in to get care, and it's triggered that they would benefit from some sort of care management. So it triggers that they benefit from having somebody reach out to them, some nurse involved with or some care manager reach out and talk to them about what's going on. And so they do that, and they start to engage with them around their care, and you start to nail it. Okay, well, maybe it's clear that they've been put on the wrong path, and so you think they would benefit from, instead of going down the care path they're going down a slightly, using some digital solution. Well, if that digital solution is something that you've acquired and fully integrated, you can make that a seamless process and increase the probability that individual will engage in that program that you think they would benefit from, because you've figured out you've truly kind of integrated it. The second thing is, and you talked about it from a navigation, is if you've also then acquired and integrated it fully in navigation capabilities that help you say, well, yeah, it looks like you need to have, I don't know, a knee replacement, let's say, from a musculoskeletal perspective. We understand that's what you need to have done, but let's help you find the very best surgeon provider to deliver that care and engage with you around that procedure. A provider who delivers the highest quality care and the most clinically appropriate care, and doesn't do things that you don't need. And if you can do that in an integrated way, I think that's actually how you create more value. And so I think when you look at employers saying they're not just looking for one-stop shop, they value real integration, that ability to take that experience for their employees, for their plan members, for that consumer, and make it really easy, very seamless, but fully kind of connected, and not have you kind of bouncing around between a bunch of different point solutions to fully address your needs. And so I do think that I think your perspective on consolidation is spot on. I think the reason that it didn't occur is exactly what you described. If Transcarent and Glenn Tallman and that team, who are extraordinarily bright, had wanted to do this, I don't know the time frame, but let's say go back 5 years ago, Accolade was a company who was worth almost $5 billion, not $600 million. And so it's harder to kind of justify it. I think the reality now is you can do this consolidation because the valuations of these businesses that you want to integrate, that you want to create a more complete solution, are just are going to be a lot less.
Great, thank you. Yeah, so to try to say, what does this deal symbolize? I think one thing it symbolizes is that a long-delayed consolidation is going to happen in this employer health tech sector, and this is an example of it. And you may see certain leading companies get funding backers and use that funding to go and acquire point solutions to us to fill out suites in this sector. So people copying what Glenn Tallman is doing, for example. And so I think that the consolidation wave, which the time is now more ripe because we're, in public markets, of course, everything's valued, all day, every day. And in private markets, you have companies holding out for unrealistically high valuations, but that's coming to an end as they're seeing deals get done at these lower valuations. So, and then another intriguing story here is the story of taking companies private. While unicorns all want to go public, you're seeing many companies that have been public for several years being taken private. And so there's a lot of arguments why private capital markets are sometimes better. And this is now when they're young and want to go public, they're backed by VCs. When they are public, they have public investors behind them. When they're taken private by private equity investors. Mm-hmm. So different kinds of investors want them for different reasons. And a private equity investor would love to take a fallen angel, a company they still think has potential, but whose stock price has fallen, and then buy them for a cheaper price than they could otherwise get, for example.
I think the big one there, and this is one of the realities that I do think is a sort of challenge and mistake in the public markets that makes it difficult, particularly for healthcare companies, is that these businesses don't run, healthcare businesses, digital health companies particularly, don't run on sort of a natural steady state quarter to quarter business. I mean, even coming from Walmart and retail, right? Everybody knows that in retail, if you're in the type of retail that Walmart is in or Amazon is in, Q4 matters way more than Q2. And so they sort of, this idea that, but you're still requiring me to measure myself on a quarter to quarter basis, and even in some cases on a you want to know how I'm performing this year. Well, I'd argue that if anybody's doing anything, I've looked at, actually been involved in a lot of value-based contracts. There was a group in the physical therapy space that has put in place a phenomenal value-based arrangement. If you were to try to measure that on their performance on a quarter-to-quarter basis, or even on just looking at it a single year, you would get a poor rate. It's a 3-year deal, and so you really need to look at it over that 3-year period and how they perform. And if you look at what has happened over 3 years, in aggregate, it has been a phenomenal deal for them and for the plan that they're working with. But if you looked at it in isolation of a couple quarters or even 1 year, it would look terrible. And so I think that's part of the advantage as well, is that some of it is that I think some of these PE firms are just recognizing that the structure of trying to operate a public market and the obligations that go along with it from an SEC perspective and the like just don't line up with the realities. And so if you take it public, you can sort of really focus in on the business in the way you should focus in on the time frame. If maybe yours is an 18-month cycle, or it's a 24-month cycle, or whatever it is, and you're not sort of burdened by what comes with being a public company. So I think that's one of the advantages that I'm hearing from groups, is that when they make that change from public to private, is they can kind of align their interests operationally with the market better, and not kind of be beholden to this quarter by quarter life.
Yeah, that's interesting. So a lot of digital health unicorns have gone public, and there's a significant expectation of top line growth. So top line growth expectation might be over 40%, top line growth per year. And then there's a joke in digital health, which is that in B2B, a 12-month sales cycle is a long sales cycle, whereas in digital health, an 18-month sales cycle is a short sales.
That's right.
There's nothing is more common in digital health than that a sales rep is saying that I'm going to be able to close this by this quarter. And then the large healthcare enterprise just says, we need to push that off 3 months or whatever. And that's incredibly common. And the sales rep has no control over that. And then suddenly now the company's missing its quarter by 2 cents. And then it pays, maybe its stock price is down 15% on that because the market's saying, well, you can't deliver on this growth. And so that's very common.
Well, I'll give you a quick example. I won't name the name, but there was a digital health startup that's working with one of the major managed care carriers that is out there, and they have a program that they ran a test and was wildly successful. And what it showed in aggregate is if this carrier then implemented it across their entire books of business, it was going to generate about $50 million in savings. What ended up happening is the group that they're working with said, we're actually going to stagger you in, so we're only going to move you into enough of the book to generate about 10 million savings this coming year, and then in the next year we'll move you into a little bit more that will mean the aggregate savings is about 25 million, so about 15 million incremental. And in the third year, we'll move you to all of it, and we'll get the full 50 million in aggregate savings and 25 million incremental, so that it phases in. The reality is these guys, their investors are looking at them and saying, "Good deal, you signed this group up, and they've committed to a 3-year deal, and they're going, we know how much you're going to make over it." But the absurdity of that, in my mind, is that the rational person would say, implement it across everything and take the full 50 million savings right now and run it in perpetuity. But that's not, sometimes public markets work. So I think that's why I do think we're going to see some of these businesses pulled out of the public. They were just never really right for the public markets, I think.
So let's move on to our main topic. We'll skip some of the other topics, but I'll go to personal notices. So this is where we tell our audience about things that we're doing. And so I'll just mention that my next show is going to be on Wednesday, January 22nd, with Neil Shah of Care Yaya talking about a framework for thinking about age tech. And then I'm also doing a drinks night in Boston on January 23rd. And you can find my upcoming events on stephenwardell.eventbrite.com. Marcus, do you have any personal notices, any ways for our audience to connect with you?
If anybody wants to connect with me, the easiest is just track me down on LinkedIn. That's become my now go-to way to kind of stay in touch with a number of people. So just find me there. But I don't know that I have any big. You're doing all the exciting events, so I don't know that I have anything exciting coming up anytime soon.
Well, thanks. And then our main topic is about what will happen to employer health tech. And so can you start? You're very well suited to address this question, but how would you describe the evolution of the employer health tech sector over time? I know that there's a story in digital health that for 15 years, this is one of the favorite places for investors to invest, where investors would say, "Oh, do you have IP on diabetes? Well, instead of selling that to the provider, you should work out a package to figure out how to sell that to the employer and have them make it available to employees." So VCs would literally direct entrepreneurs to sell into the employer health tech budget, making it a very popular avenue to go down for commercialization. But how has that evolved over time? It's not nearly as popular today. So what's been happening?
I think the reason I think it evolved the way it did, and I'm going to be a little blunt, which said if you sort of go back and you look at and I'm going to really talk about the last kind of 20, probably 25 years, that I would say where it kind of started is you had, again, if you were a particularly large employer, and I'm going to talk about the large kind of mid-sized employers, those who are self-insured, I think it's a different reality for the small to mid-size that are having, can't be self-insured and are fully insured. But for those that are self-insured and for the employer that, most when they were going out and getting solutions is they were getting the solutions from their ASO. and it was, I work with Blue Cross, I work with United, I work with Aetna, I work with Cigna primarily. And in that case, I'm paying them a lot of money as my ASO, and I expect them, they bring me everything I need. And I'm probably overly simplifying this, but this is my sort of sense of it from what I kind of see or had seen on all sides. What emerged is there were a few companies that sort of popped up and said, hey, I think I look at the 100 or 200 or 300 things these ASOs are doing, and I think I can do that one thing that they're doing better, and so I can build a solution, and I can sort of just chip away at it, and so I'll go to employers and say, instead of getting X, instead of getting your diabetes management solution from your employer, I've built a better version of it by my thing, and I can show you that I can deliver, better engagement, better ROI, those kind of things. And many did, not all did, but many did. And so employers looked at it and said, oh, we did. We put this in and we actually got better results. We saw some health improvement. And I think then other innovators and entrepreneurs saw hope and promise in that, and they said, well, what other area can I kind of chip away at? What other thing can I take? I mean, honestly, the groups we talked, like Accolade, got created by an employer, by Comcast, functionally, because there was a fundamental belief that they could do that function better than an ASO, and so you'd seen that in an array of companies that arose, and that was great, and in many cases that was wonderful because it did two things. One is it did generate benefits for the employers. They got access to these innovative solutions that could drive greater impact. Two is it actually forced the ASOs to be more competitive and think about their own solutions, and if their own solutions weren't working, then if you can't beat them, join them. So they might go out there and partner with, or even in some cases acquire some of these point solutions in the market. So that was all well and good. But what happened? What happened is the counts. It wasn't like 50 of these companies existed. I mean, I didn't think about, I was just working in the musculoskeletal care space with Rightmove, that there's not one or two companies in the MSK space. There are a lot of companies who kind of entered that space, and everybody's doing something just a little different than the next, and maybe even sometimes a lot different than the next, but it's overwhelming. And so there are thousands, tens of thousands of companies playing there. And if you're the employer benefit organization, and these aren't big organizations, these are not 1,000-person teams. These are sometimes couple-person teams, even for some of the biggest companies. They're not lots of that. They're just overwhelmed by the sheer amount of solutions. And so what happens when you get overwhelmed? You're like, I can't handle anymore. So I'm not gonna take more meetings with any more of these innovators. I'm gonna either stick with what I've got or just, again, go back to relying on my ASO, or maybe I've sort of switched to a TPA and but I expect my sort of TPA to bring these things in. Well, even the ASOs and the TPAs were getting overwhelmed. They're like, I don't know how to assess everything's in the market. So I think that was where we sort of found ourselves over the last number of years. But I think if I were to describe today, there's two things. One is, we are, because of healthcare inflation, let's be clear what employers are dealing with, they're back to recognizing that healthcare trend is out of control, and you got to get it managed, and you can't afford to have 7-8% increases or even 10% increases in your healthcare spend year over year. You can't afford to have your health benefits cost be your fastest growing expense line item for your entire corporate P&L, because that's, it's not good for anybody. It's not good for your corporation, but it also brings heat to you. So you're dealing with that reality. So you do feel pressure to do something, but at the same time, you're still overwhelmed. And so your inclination is to look who are groups, who are aggregators, integrators that can bring me an array of solutions, that I can work with one group or one or two groups who can carry the bulk of the water for me. And so I think you're in the midst of that transition and a desire. And does that mean that these employers then go back to becoming more reliant on their ASOs and TPAs? Maybe in some cases, or they're expecting the kind of market to react. And so I think that's the moment we kind of find ourselves, is that kind of still every purchasers really overwhelmed by point solutions, understandably, but also really looking truly for things that help them improve the health of their employees and their plan members and help their employees be more productive and live better lives, but also control costs and control trend in a real way, but do it in a way that's not insanity by having to manage. I can't manage 400 vendor contracts. I can't even manage 40 vendor contracts. How do I kind of have that be more reasonable? And so I think that's the kind of space we find ourselves in today. And so what that means from an employer benefit perspective is, and this is from my experience here, particularly recently, they're having to be, if they are going to work with point solutions, they're working with point solutions in they're identifying the priority areas for them. So they're going to say, this year I only care about one or two areas. I care about cancer, or I care about MSK, or I care about high value navigation, or whatever it might be, and I'm not gonna. The rest of it, I'm getting from my sort of aggregated partners, and so I think that's kind of where we find ourselves at the moment. And honestly, I don't expect that to change soon. I think that's going to be sort of driving trend for a while. I mean, maybe we could have some other strange COVID event. Our good friends in China continue to produce strange diseases that we hear a lot about, and maybe one of those will rear up and cause us problems. But my sense is this trend reality is a big one, but this overload reality is a real one too.
Great, interesting. And so now we covered this a little bit, but let me frame this as, how are the needs of buyers changing? So the buyer is usually the benefit leader at the progressive large employer. That's what buyer we care about a lot. And I'll just mention some trends that I'm seeing. Would love to get you to react and add to this. And this will cover some similar ground that we just covered now. But one is that buyers want suites. And so if I were to define what the suites are things like all wellness and fitness together in one suite, all care management for the big diseases together in one suite, all consumer directed benefits like HSA, FSA, HRA, COBRA, commuter, all together in one suite. Health Equity has that. All enrollment together in one suite, all telehealth together in one suite, all mental and behavioral health together in one suite. So that's a suite idea. And then integration, we talked about that earlier in the show, but integration can mean a single sign-on, analytics across all of them, proof of financial return across all of them, and gamification across all of them. If you have points within the company for good behavior or whatever, it works seamlessly across all of them. And so you have a suite with integration. That's one. And this part of that is what I just mentioned. I'll call that a move from not mere functionality, but to also meta functionality. So functionality is my diabetes solution improves H1C levels by 0.9 points. That would be functionality. Meta functionality is I pre-guarantee it is IT security compliant. I pre-guarantee it integrates with Oracle PeopleSoft. I pre-guarantee that it integrates with all the other elements of the suite in the way that I mentioned before. So that's meta functionality. Employers used to not ask for that. Now they're starting to ask for that because they don't want to dedicate staff resources to do this work for the vendors. They just want it to work in this way. And this is part of a raising of standards. So if you arrive with a slightly better diabetes solution, you don't have these other quality measures, then you're not as interesting to them as you would have been 10 years ago, for example. This is some of what, and you mentioned also that employers are feeling the pain again of healthcare trend being out of control, of unexpected, unacceptably high increases in healthcare costs for the employer. And what are they going to do about it? What's benefits going to do about it? Any other thoughts about the changing needs of buyers of programmatic benefits and of other similar benefits?
I think you sort of nailed them. Maybe the only other one that I would say that it seems a little bit on the fringe, but I wouldn't sort of ignore is the changing nature of the workforce and some of their expectations. So if you think about, I'm fully in the middle of Gen X, and Gen X had its own sort of set of desires and expectations. But if you think about those that are sort of the generations now behind Gen X, they're coming in that are now a much larger force in the workforce and will continue to be. I think you're also seeing expectations from them around when they think about benefits and they think about an investment in health and healthcare by their employer. You are seeing kind of increased expectations in things like behavioral and mental health services. You're seeing the role, in a phenomenally good way, but the growth of female leaders in the workforce and other minority that sort of translating into some expectations around your benefits. So when you think about how many large employers today are providing and cover fertility benefits, and you compare that to 10 years ago, and certainly 20 years ago. I mean, 20 years ago, it was almost unheard of, and now it's very common. So I think that's the other piece that's happening, is that all those things you just described are exactly right, particularly the integration, the looking for more integrated solutions, more holistic solutions. I like your suites idea. I think that sort of makes sense. I also say, hey, I need somebody who can help me bring the innovative benefits that apply to my emerging workforce that might not have been what the sort of workforce that I have that's aging out was demanding, but now the sort of newer workforce that's coming in is expecting and looking and demanding a new set of things, of solutions, and those are good things to expect, but you're gonna have to bring them. You can't just keep kind of saying it's the days of just it being enough. Well, I mean, go back even 20 or 15 years ago. I would say it was if you were in commercial benefit or employer benefits, your focus was MSK, maternity, and metabolic syndrome. I would guess for the most part, right? And diabetes, heart disease, those kind of things. Today, cancer, and cancer is rearing its head, and we're seeing sort of cancer rates increase, and the array of cancers increase, particularly among younger populations. But now behavioral health, mental health, and as I mentioned, women's health and other areas, a lot of those are being driven by expectation, not just what's happening from a healthcare trends perspective, but what's happening from a societal demands perspective. And so you've got to roll with that too. And so I think that also is making it harder. Not easier. I would tell you some of the truly brightest people that you will find are the heads of benefit plans and health benefit plans at a lot of the large employers. And I mean, I actually think they have one of the most difficult jobs because they're having to kind of understand all these trends at once. And it's tough, and stay on top of it and make everybody happy. And I'm always sort of mindful. Lisa Woods, who's at Walmart, I feel like has the hardest job in the world because she's trying to build a benefit plan that appeals to people that are seniors and that are also 18, and I'm like, well, and that are all walks of life, and so that's tough. That's tough. And so I think those are the challenges that they're facing today.
Really interesting. And so I guess two examples I would give that supports what you say. So one is that we had COVID caused this massive trend across the whole workforce, especially the young, of wanting to work from home, have some flexibility. Could be 5 days a week, could be less. And so you had this traditional benefit, which was to get a discount on the gym coming from your employer. And that's a bricks and mortar benefit. And maybe the gym is near the workplace, for example. But suddenly, what do you do if no one's coming into the office because of COVID? And so that switched to companies like Fitbit and Whoop. That was a really interesting switch from bricks and mortar to digital, where you could have a national benefit, which was to get a discount on a Fitbit device. And then possibly maybe there's even a program at work to do a step count competition between marketing and sales or something like that. But that was a great example for people in the innovation sector of software stealing the lunch of the bricks and mortar gyms, for example. But that's an example of a different kind of benefit that might take the place of the gym benefit. But also with a changing workforce, if there's a tragedy in the family and you really want to talk to a therapist, the older worker is going to be okay with finding someone local, maybe who has an office on the main street of their town, driving to that office during the workday, parking, paying for parking, going in, waiting in a lobby, being called into a room, talking to someone, talk therapy for 45 minutes. The younger generation expects to get their healthcare from their phone. And so there's a very different kind of benefit for younger people. And that might be more efficient. And I hope it's as effective as live face-to-face in-person talk therapy. But younger people might want to get it from their phone. They might be okay with it being asynchronous, textual and asynchronous. For example, there's big implications for efficiency. There's not enough providers out there, so there's big implications for efficiency if young people can adapt to asynchronous text, for example. But those are intriguing examples of changing workforce, I'd say.
Well, I mean, I think the problem. Let's be clear. I think there's an emerging group who had somebody describe this, that it sounds strange, but we're going to be talking about it in 5 years, that there is now a generation of Americans who will have grown up with Chat GPT and know how to converse greatly and feel very comfortable conversing with AI. I'm still clumsy and with it myself, but the result of that is will be very comfortable in an environment getting care delivered to them via AI, meaning don't have the same expectations that I want to sit down with a doctor, could maybe care less. Like what they want is what's the sort of best, most convenient way to get the answers to address what I'm dealing with in the moment, and help me understand what now that I know what's going on, what should I do about it? So I think that's what we're going to start to see more of that as well, is some of this in this omni-channel world, the expectations of where and how people, the pathway that they look to take to get the care they need is going to shift. And so you as the benefits leader have to go with the flow on that one. Otherwise, you're going to have a plan that's going to be largely underwhelming to the employees and beneficiaries that you serve.
And so let's move on to just our last couple of questions here. And for our audience, if you have any questions, now is your last chance to ask them. But looking at where the sector is going, so if I were to cycle back to 2009, you had global financial crisis followed by Fed's ZIRP, zero interest rate policy, along with meaningful use in the government dropping a $40 billion subsidy on the heads of hospitals and EMRs. Coming out of that, you had massive entry of new companies and products into employer health tech. And so then there were analysts on Wall Street who would say, we've seen a lot of entry into employer health tech, but now we expect it's 2015, and now we expect to see a shakeout where lesser companies get shaken out of the sector, companies that weren't addressing a big problem or didn't make it in the top 4 market share, they sort of get shaken out. So we expect to see shakeout and consolidation. We expect that large vendors or healthcare incumbents are going to buy these employer health tech companies. And you didn't see it. I was actually on Wall Street saying it's 2015, it's time for there to be a shakeout and consolidation. It's 2020, it's time for there to be a shakeout and consolidation. And you didn't see it. What you did see was high valuation levels and more capital coming in and funds getting bigger and putting more money to work more quickly in the sector. And so you have a sector that had a lack of shakeouts and a lack of consolidation for a long time in the sector. And now we're seeing calls that it's time to have the mother of all shakeouts and also the mother of all consolidation waves. And Alyssa Jaffe of 7wire and Chrissy Farr, who has her own fund now, I think it's called Scrub Capital, they have put out a thesis that added to this chorus saying that there needs to be and we expect to see consolidation. So I think consolidation is going to be driven by the benefit in employer health tech, by the benefit leader demanding to buy suites and enterprise buys. But they're saying that you need consolidation because the buyers are so enormous these days that small vendors will simply be overlooked. And so VCs would be wise to combine the like companies in their portfolio together to get scale to matter to large buyers. So we have different voices saying that it's going to happen. So what do you think of my description of this sector? And do you think that, I think what was holding it back in the past was it was too easy to raise another large round of funding at a high valuation, that people who might have had to give up and let their company fall by the wayside, they were still able to raise money. But leaders who might have said, I'm going to sell my leading company in a trade sale to a consolidator, they said, I'm going to go raise a large round at a high valuation. I'm going to be the large vendor and the consolidator in the future instead of selling to them. And so that environment's over now. And that's what's setting the stage for consolidation, probably in a buyer's market where buyers can pick and choose who they want to buy from among the many entrants in the sector. But what do you think? Are we on the cusp?
Yeah.
Is this transparent deal an example? Are we on the cusp of this long delayed, long expected, but disappointed and long delayed consolidation wave?
Well, I think some of that didn't happen because I think you had a combination of ego and easy cash, easy money to access. So when you put a lot of ego in the room and you make money, cash easy to get, then you don't get consolidation because everybody thinks they're the ones that should be consolidating. They should be the ones that are the mothership, and you join my. And so I think that was part. I think it was not. It was driven by ego, and it was easy for people's sort of ego to control the day because the capital was so easy to come by. I think that's shifted. I think back to your point, maybe to your comment about Chrissy and others, I agree completely. I'm always leery to kind of predict it. It feels like that's what we're going to see. The transparent deal, that we're going to see more like that. What I feel like I'm giving a rational or logical answer. What I believe the market would benefit from is more consolidation and integration. Again, back to where we started on this, that's focused around two things. And when you talk about to benefit these kind of large employer payers, and frankly to benefit consumers, I think one is groups who are truly about delivering things at scale. And I mean at scale, if you're a Walmart, if you're a JP Morgan, if you're an Amazon, if you're even if you're a Toyota or whatever, because you have manufacturing spread across the U.S., I don't need a solution for Texas. I don't need a solution for Florida. I need a solution for the United States. And maybe I even need a solution globally. Let's not sort of ignore that one. So one is the ability to operate at scale to serve all of my employees, all of my members, all the people that I want served everywhere they exist, and that I don't create a two-class system that I'm only serving people in Texas with X because X is only in Texas, but I serve everybody else with Y because X is only in Texas. So I think that's one. And I think two is you talked about it. I think you used the term suites. We've talked about integrators. It is this idea of bringing together synergistic solutions that the proverbial 1 + 1 + 1 = 5 kind of deal. The idea of bringing those solutions together so that I can deliver both greater impact and make it easier for the purchasers, where they're not having to go out and get each of those things individually, but you give it to them on an integrated basis, and you're willing to go one step further. You are willing to even take risk, meaning I will guarantee you, because I've created this full integrated solution that it addresses everything in this area. Maybe it's in MSK care, or maybe it's even a step up from there. Maybe it's for all care management, that we're willing to put our money where our mouth is, and we will guarantee you an outcome. We will guarantee you that your trend won't go above 3% year over year on, per member per year. And we'll do it because we're comfortable, because we've actually integrated a full experience around it. And we're not just we're not just a widget, but we're actually the full solutioning. And so I think that push to value on the commercial side that employers are starting to look for. It's not like what we're seeing in Medicare Advantage, but it is starting to emerge. I think is going to put pressure on integration for sure. So for me, it's a scale game and it's an integration game, and I view those are different points. You can be a point solution that's scaled, but you're not holistic and integrated. You can be an integrated solution who's not scaled because you're only operating in Florida, Georgia, and North Carolina, which doesn't help me if I have California employees.
That's great. Well, thank you. So, any other thoughts on the future of the employer health tech sector for our audience?
I think the only thing I would watch is the sort of ICRA play of, do employers make a pivot to creating a defined, instead of it's a defined contribution over a defined benefit play, and what does that sort of mean for the market? I think it's worthwhile for us to watch that play out. You are seeing a lot of conversation from employers. There's been some movement, but it's not been overwhelming yet, but we're early on some of it, and some of the kind of underlying infrastructure has to be built out to enable it. But that also could be meaningful. I think how that will kind of play out could be important. And there's a lot of talk about it. There's a lot of conversations being had in a lot of boardrooms, and a lot of CFOs and heads of HR collaborating to say, what would this mean if we make a move? And so that's probably the other piece that I think I'd encourage people to just keep your eye out, because it'll be meaningful about in the market. What that may mean is, the groups who sort of are in the individual plan business are, your ability to create individual commercial plans. They're fully insured, or there's going to be other opportunities that emerge there. So it may not be the employer benefit head who's really doing the purchasing anymore. It may be putting more power in the hands of the consumer to make those decisions, and so that also creates opportunities.
That's great. Well, thank you. Thanks very much for joining our show. So you've been listening to Digital Health Investor Talk with host Stephen Wardell, and thanks to our guest, Marcus. Thank you. And we'll be publishing this show as part of the Digital Health Investor Talk podcast. You can subscribe on Apple and Spotify, and don't forget to rate us. Our next show will be on Wednesday, January 22nd, a tech framework for aging in place with Neil Shah of Care Yaya. And other than that, I'll see you at JP Morgan. So thanks to our audience, and thanks Marcus.
Thank you.